So what are some assets that are liquid, or what we also refer to in this business as cash equivalents, and what are assets that are illiquid and come with heavy cost to get your money out lickety split at little or no cost? Let's take a look first of all at the liquid. Well, we have bank instruments such as checking, savings, CDs, money markets, and this is going to surprise you, HELOCs. Now, what is a HELOC? Well, that stands for Home Equity Line of Credit. And in many cases, when you retire, especially if you have most of your money tied up in a tax-infested 401k plan and you need a large sum of money, a HELOC is a good place to go get money in terms of liquid cash. Next, we have the insurance products and insurance companies, which include cash value of life insurance, short-term annuities, and of course, what's called the penalty-free withdrawal, PFW, the 10% penalty-free withdrawal of annuities. You see, there's a lot of misconceptions about annuities out there. Many people think, well, put my money in the annuity. If it's a 10-year term, which we're going to talk about terms on annuities next week, but it's a 10-year term, that means I can't even touch the money for 10 years without a penalty. Well, that's partly true and partly not, because most annuities, after the first year, will let you take out 10% every year out of the contract penalty-free. So it's a wonderful provision to provide some liquidity. Next, we have the government, and those would be short-term bonds. You could even throw the I bonds in there, quite frankly. So short-term bonds, government bonds, short-term maturities are very good for liquid cash. And finally, speaking of cash, just cash, whether it's in your pocket or, buried in the backyard. Now, let's go to the other extreme and look at assets that are not so liquid, or what we might call illiquid. These would be assets that either come with penalties to get your money out or huge costs, okay? So let's look at the first one. This surprises people, the 401k plan. You know, again, I'm not against the 401k plan, folks. What I'm concerned about is all of these people. I had over 20 appointments yesterday in the Louisville office alone. That was in one day. And more people are coming to me, retired or retiring soon, and the majority of their assets, I mean the vast majority of their assets, is the 401k plan. And folks, the 401k plan is not a very good liquid investment. Number one, a lot of times based on your age, you can't even get the money out. And number two, those darn taxes that are there to eat your lunch. Oh, incidentally, coming up in our next segment, we're going to talk about liquidity issues and a case study I did, so good stuff coming up. All right, what else? Well, IRAs, they're qualified plans too, have much of the same problems that 401k plans have in terms of liquidity. What about pensions? Yeah, pensions are not liquid at all. If you take an installment, once you start that installment, you can never change that election option. Also, if you have a lump sum pension available, sometimes they're a little more liquid and we can help you with that. Obviously, stocks, and you might say, well, wait a minute, Tony, I don't agree with that at all. I can sell my stock at any time. In fact, Derek, let's go on and put up several of these. We got bonds, mutual funds, and let's hold off on long-term annuities. So I want to focus on those three: stocks, bonds, mutual funds. Remember the definition of liquidity. That means you can get your money out at any time, lickety split. So in this example, you could sell your stocks, bonds, and mutual funds. The problem is, remember we said, without risk of loss. See, a stock, let's say you need $20,000 out of a particular stock and the stock is down. Well, yeah, you can liquidate it, but you might take a loss. Same holds true for bonds. Right now in our portfolios, we're having to deal with this. These darn bonds are going down in value because interest rates are creeping up. So the value could still be going down, as the same with mutual funds. Derek's already got this up. And the next one is long-term annuities. Now you got to remember, folks, I love annuities. And long-term annuities have their place as long as those long-term annuities are within a structured and written game plan that has other assets. Remember, folks, and I'm seeing this more and more, you are running out and you're dumping in all of your money into these long-term annuity contracts. You're taking all flexibility, all use, all liquidity right off the table. Please don't do that. So if anybody's pitching an annuity to you, especially if they're suggesting you put the vast majority of your money in annuity, don't do that. Don't get stuck in the wrong annuity. Get a second opinion from us, or better yet, go right now to TonyWalkerFinancial.com, download the free annuity guide. It's called Annuities Made Easy. It'll tell you about all the surrender charges. Again, next week we're going to get into that as well. And then finally, let's see, I think I've got two more here. We've got real estate investment trusts. They're not very liquid at all. And then commodities, which again, you might say are liquid, but again, we've got a problem because depending on when you take out the gold or silver or go to liquidate it, that value could be way down. So the point is, liquidity deals with protection of principal, it deals with access to your money lickety split, and it deals with hopefully money you can get out without penalty.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.